Welcome to the Salty Investors episode number 27. How are you today, Tim?
Yeah, pretty good yourself.
Not bad, not bad. I suppose I should say it is Good Friday, April the 6th, 2023. And of course, this week, Tim, we've had quite a few events on the central bank variety. Let me go first with my salt of this week. The Reserve Bank of Australia decided to stay on hold with interest rates. The very next day, the Bank of New Zealand came out and raised 50 basis points, going up to 5.25. We're at 3.6, and I'm just a little. I just think that our central bank is a little bit soft. That what inflation is year over year 6.8%. We're at 3.6. Oh my God, we better wait and pause here. I think that this just goes to show how fragile how leveraged to our housing market we are, how our household sector, how in debt that sector is, that we're so scared to raise rates any higher. Anyway, and the RBNZ's good. No, screw it. We're going. We're going to get this thing under control. So that's my bit of salt. What do you reckon?
Oh yeah, it's a bit extreme from New Zealand, but they might have a harder landing, but I think it's the right move. I think they're on the money here. Like expectations are definitely down in New Zealand, but you see in Australia, some housing sectors are actually increasing in price again. So
I think they are too.
We don't want to end up in the 70s where expectations get out of control again, and these constant hiking and cutting, over and over, just ground the economy to a halt. So I think New Zealand's doing the right thing, and they'll, get in early, get the pain over early, come out strong. That's what my idea is. But
I mean, I think they have a couple of. I mean, they have some inflation in goods and services related to natural disasters that have happened that we don't have. That's put more pressure on prices over there than ours. So there's a bit of that. But I mean, I like their commitment. They seem a bit more committed than our guy, than old Phil.
Yeah, well, they've got a housing boom as well. It's not like they're immune to that. They've got a bit more fixed in there, so I can understand how rates aren't gonna affect as much as compared to Australia. But overall, I still think it's a booming housing economy over there, so they've got excuses as well. So
the other side of this is of course, the chattering classes are the ones who are more likely to own housing, or landlords. Look, this is a great boon for people who don't own houses, especially. I mean, we'll get onto this in a minute. I don't want to spend any more time on it now, but the house prices in New Zealand have come down a lot, and are still coming down. But before we get to that, how about, have you got some salt other than some extra salt to pour on the central bank?
No. Last night my kettle blew up, so coffee in the microwave this morning, and thought, oh well, I'll go and look online, see if I can buy myself a kettle, and found a glass kettle for $34 at Harris Scarf. I thought, wow, that's pretty good. And then I'm getting told that manufacturing is coming back to Australia. I think, how is this possible? Like, how is it possible for someone in Australia to make a kettle for $34? Like, Harris Scarf have got to be taking $5 out of that, surely, or $10.
Yeah, exactly. They're going to be making it for probably 20 or 25 at most, right?
Yeah. And so I can't see someone putting a kettle here together for $2 or $3, and the materials costing whatever. Like, I just can't see it happening. Or things are going to go up to be 3 times the price, so everyone can earn 80 grand a year. I just can't see how manufacturing is possibly coming back to Australia.
So who's spruiking this manufacturing's coming back stuff? Is this the Business Council or the Labor Party, or who's
mainly
doing
the
this?
Labor Party, who think this is the way forward, to get growth and everything back into Australia, which is good if it's the free market. But all I can see is like tariffs to make this thing work. Like, how can you beat a $34 kettle? Like, this is, even the cheap end is an $18 kettle. Like, I'm on the medium end. Like, so I just can't see how this is going to work, unless people aren't happy with affordable goods. How's this going to flow through to the economy? So
Yeah, we've seen all that before. Hey, buy Australian. Is it more expensive? Yes. Fuck that. People care about what it costs. It's the same argument about mum and pop stores. Oh, the poor mum and pop store. Why don't you keep shopping there? Oh, it's more expensive and they don't have as much range. Oh, is that why? Yeah. Okay.
Yeah.
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 Strange, isn't it? Very strange. Yeah. I mean, and the other, we should mention one of the components that enables you to manufacture things at low prices is usually cheap electricity, which we don't have. Still waiting for the $275 decrease in the energy bill that Albo promised, but not going to hold my breath on that one.
No, that's not going to happen. So yeah. So yeah, just one of those things, I guess. You're told something and it doesn't really match up into reality. I think everyone likes the free ride of China producing everything and the deflationary aspect of it, but I don't think people in Australia are really willing to work those sort of jobs. But maybe I'm wrong. We'll see.
Well, I found out recently that every 6 minutes someone gets added to the NDIS, so pretty much everyone will be on NDIS soon. So there won't be anybody to work, and we'll just need to, instead of having 400,000 people come in the country every year, we'll need about 1 million.
Yeah.
Be good for Harvey Norman though. That's the main thing.
Harvey be happy.
Yeah. Well, let's move on. Let's talk about the RBA. So this is just a compilation of things. That headline there, the Reserve Bank of New Zealand's more worried about inflation than the RBA. That came from the Financial Review, and I've just put the headline in there because it's pretty obvious after what happened this week. The paragraph there is the last paragraph of the RBA's statement this week. So I wanted to just point out the board expects that some further tightening of monetary policy may well be needed. So this is not, would you call it hawkish? It's definitely not dovish. That if I had to, and I've put the futures there. So it looks, they're pretty much saying it'll be on hold, right? For next month, and it would be. Yes. I think it'd be weird, wouldn't it, if they stopped and then the very next month they went again. I mean, they would look silly for doing that, because you would go, well, why did you do that? Why did you go on hold for 1 month? That doesn't seem to make any difference. But I just want to point out that it doesn't. I don't think a lot of people have said that the tightening cycle's over, and they might be right. I don't know. Flip a coin, but I wouldn't be surprised if sometime down the track you get another one. I think we said this last week, they've bought themselves some time. They can wait and see how events play out globally. Are there indicators turning down, et cetera, et cetera? So it's, from their point of view, it's good PR. Phil, they get the monkey off Phil's back. Phil doesn't, because Phil, let's face it, Phil Lowe has copped. He's like the most hated man in Australia, even more than Peter Dutton, I think. So, which is saying something. So that gets his monkey off his back for another month, but may not be over.
So what's your vibe on this? How many months of pausing do you reckon this is? If you had a guess.
At least 2, if not 3. And I think the only thing that would change their mind in the interim is if nothing deteriorates anymore globally, like it just keeps going along, like the US keeps going along, the unemployment rate doesn't really budge. Same here, the unemployment rate doesn't really budge, and we get a sawtooth in inflation. We get a bounce up again, which is always possible with the month-to-month data. So, like, could you imagine if they've stayed on hold, they stay on hold for another, let's say they stay on hold for 3 months, and year over year inflation is still hovering around 6.5%. I mean, what do you do? I mean, do you just hope it comes down?
Well, if they chuck a 50 at it,
you got, it's Arthur fed,
Well, they could chuck a 50 at that point, and that'd really freak the market, like doing New Zealand. So I don't know, but I think 2 to 3 months, holding pattern is quite, I think, acceptable at the moment. We'll see what happens. Inflation is due to come down, like we know that. Housing is leveling off a little bit here, and it's just lagged. So, but they've got it coming down to that 2 to 3% inflation range eventually. So,
well, yeah, but you should mention there that the RBA doesn't expect 2 to 3% range until 2025. That's still their central forecast, which again, their forecasts don't mean anything. They're never any good anyway, but that's a long time for it to come down.
I looked at them yesterday. They got huge bands on them, like
Yep.
about a percentage each side of that as well. So the confidence bands there aren't very confident. So
yeah.
Yeah.
Well, I think the other thing with the amount of labour flooding into the country, the idea, and remember, real wages have gone backwards in this whole inflationary period in Australia. They haven't kept up at all. And the amount of labour that we're pushing into the country I can't see, wage rises being embedded into expectations, because they haven't been really, People have just had to suck it up thus far. Okay, so the RBNZ, different story. They just went, fuck it, we're going 50.
Yep.
So they're up to 5.25. We're at 3.6. They're at 5.25. I probably should have put a graph up of both of them, because you can see this divergence happening. We were sort of going in lockstep, but there's this divergence. And just on the topic of house prices, I mean, these are New Zealand dollars, right? But Wellington's values are down almost 300,000 in certain parts of Wellington, West Wellington, 1.4 million. And I don't know anything about, is West Wellington a nicer place to live? Maybe it is, looking at those values. Down 355,000 on a house that was 1.4 million. But I mean, that's more than what's that? That's nearly, it's between 20 and 25%, decrease in Wellington West. And good. Wouldn't you like, if you lived in Sydney and Melbourne, wouldn't you like to see prices like that? And if you bought your house not as an investment to flip, but you bought your house to live in for 20 years,
who cares?
It shouldn't worry you.
No,
it shouldn't worry. Maybe you paid more than you should, but in 20 years you won't care at all.
That's right.
So, as I mentioned earlier, there are some reasons why that these guys are going hard. I mean, these natural disasters have really, spiked a lot of goods prices. So they feel like they need to get their handle. They need to dampen these expectations. And I think they're doing the right thing.
Yeah, well, they did have nasty COVID lockdown, so they locked the whole country down. So it's one of the worst places in the world. So coming home to roost here a little bit. But they got the bank here, just doing a Volcker on them. So, if this works, it's going to make us look really like, the poor cousins. Normally we throw mud at New Zealand and think, what a freaking backward place this is. But holy hell, they got some balls over there to really fix the problem. He's going after it. So it's good to see.
The thing is, I think, is that we're in this world now where we try to escape economic downturns by sort of, no one has to endure any pain, right? As much, which I don't know why. Because if these guys have a deeper downturn, more gets sliced off their housing. Yes, it'll look worse in the short term, but they will come out looking better, because you would have gotten rid of excess. You would have, things would have been squashed right down, but you'll come out of it harder, faster. Whereas, because if Australia's, the recent turnaround in house prices, if that's it, if the bottom is in, then what's going to change in this country? Nothing. We're just going back to status quo. The affordability problem is not taken care of. Labor's mealy mouth sort of housing bill, whatever it is, it's just a fund to stick money in at the moment, isn't it? I mean, that's basically what the proposal is, rather than actually build anything. It's not going to do anything. You're just going to go back to status quo. It's actually when you get a real, solid downturn and people start to ask questions, and maybe we can do things differently, and maybe buying houses to sell them and rent them out, just this is not good, because it just inflates a bubble that has to burst. But in Australia, we've had several sort of chances over the last couple of decades. All the GFC, no, we skated through that. COVID, no. Just here we are again. Are we going to learn a lesson? No. The RBA is going to help us just skate through this one too. I don't know.
Yep.
Maybe I'm just a bitter non-property owner, and that's why
it's coming through here a little bit. I think I've got that problem as well. Like, been wrong so many times. Surely we're going to be right sometime. That doesn't have to be the case. So,
no. Yeah. So interesting what the people over the ditch are doing. I prefer their approach. Just caught this because we were talking offline. We had this, I don't know what you would call it, mini banking crisis in the US. So everybody knows about SVB, and a bunch of other banks, lesser known banks, also went bankrupt, and they had this problem where they weren't managing their interest rate risk, although they should have been for some reason, and depositors did get backstopped, even though they had more than the federally insured limit. And it seems as though the market is kind of carrying on as though, all right, that's fixed now and let's proceed. But this has put a spotlight on a problem that a lot of banks are obviously sitting on duration risk. They're sitting on, there would be more runs on banks if the Fed hadn't calmed the markets by backing these deposits. Again, I'm not sure that's a good thing. I'm not, it's just reinforces moral hazard. Yeah. Let's not have reality. Might be too shocking. But I'm interested in this idea of what's the knock-on effects from that. I mean, you can't. I just don't think you can go, yeah, well, we had a little mini crisis and now we just keep going the way we were. So this was a survey from the Dallas Fed. I think just looking at the lines, the quarterly numbers, they come out quarterly, and this is just total loan volume. The total loan volume. So this is Texas, basically. It's the state of Texas, and Texas is economically probably one of the better states, in better shape, right? It's more investor friendly. So their total loan volume's down 20%. You can see that sharp downturn there. That latest quarter is what that represents.
Wow.
And so that's Texas. That's one state. It's a pretty big state, pretty important state. And you just think that has to have some downstream effects, on economic growth. And in some ways, this has made the RBA's job easier, the fact that we had this little mini banking crisis, because it's given them the excuse to go on hold. I don't think they would have otherwise. That's I just think that we're not just going to skate out of this. There are going to be some downstream effects. I don't know to what extent. You got anything to say on that?
Well, the home builders, they're still flying high,
Yeah.
Still, and like Home Depot and all them, Lowe's, they're all still flying really high, and nothing seems to have changed. But as you can see, the loan volumes and the quality of loans that you need to have before you can actually get a loan, all that, the standards are tightening up considerably. So
yeah, actually, I didn't include that because I didn't want to spend too much time on it. But there is another chart that shows that the quality of loans, like the credit rating you need, hasn't really changed, but the restrictions really have.
Okay.
Like the tightening, in other words. So they're not lending out, even though the quality hasn't deteriorated. They're not. They've cut back, basically. Yeah. So that was interesting. This was an interesting one because if you've noticed, you've had a look at the markets the last couple of weeks, people have retreated to tech as a safe haven. And this is only, the problem with this chart is it's only sort of five years worth of data. But as you can see there, tech usually trades at a premium of about 18% on a PE basis relative to the rest of the S&P 500. And it's now, getting up towards 40%. So that, and you see where it got at the end of 2021. So it's actually further ahead. I think I saw a further analysis that said that if you took out tech, and I think retail's done pretty well in the US this year. If you took out tech and retail, I think the S&P's up. It's the S&P's not up. It's just flat without tech and retail. So the broader point here is that markets perform best when they're broad.
Yes.
So that means you have the majority of sectors, the vast majority, are participating, right? And they do it. They're at their most dangerous when they're narrow, which is here. I mean, you literally have just a couple of sectors sort of holding the thing up. Again, this is a man in search of evidence that his decision not to jump in is somehow justified. I think I need to keep saying that just in case.
I've got a slide for you coming up, so yeah, that might hit a raw nerve there somewhere. But yeah.
Well, let's get to that. So you have gone through all of our episodes, and what did you do? You basically pulled out all the stocks that we talked about. Is that what you've done?
Yep. So just thought, are we looking at junk? Are we sort of on the ball here? What are we sort of? We didn't buy all these, obviously, but how are we doing? And I thought, oh well, I'd love to find out. And
hey, 3 times the market return.
Yeah, like we're doing pretty good here. Few doozies, but I think we're done.
I should point out there that Pointerra, which is one that I brought, I did buy that before they had a quarterly result, and then sold it the very next week because the quarterly result sucked. So that was a good out by me. I think I made 1 cent. I think it went from 20 to 21 sold. It's just gone from 21 to 12 in short order.
Yeah, there's a couple here that really hurt, but there's some
Dr.
here that
Martens.
Yeah. I actually bought it at that 140 something level there, so that one's not so bad. But
I still think that's a good long-term buy. That
I do. 10 cent here. Like I knew that was just a huge $200 going up to nearly $400. Mercado Libre, that was a Amazon alternative. You can see how that's just gone crazy. Equifax here, right move. And probably the one that hurts the most is FICO. Yeah, so I loved that. I absolutely loved it. I love the price. I love the business. I understood it all, and sucked my thumb and did freaking nothing. And now look at it, like it's 60% up from that. And you look at the graph and you're like, wow, that was the actual bottom. And it was the absolute fickin' bottom. It's still a bargain today.
Same with Microsoft too. I mean, it looks like we plumbed the week we mentioned it was the bottom. Didn't get any lower than that, did it?
So I was hoping under 200 for Microsoft. Just pure greed here.
Yeah, that's what I was there. I was hanging out for the same.
But there's still a couple of facts set here. Moonpig was ones that were, like, oh, that's a bit of an out there type. It's a card type business, and I wasn't too keen on that. And look, it's just gone sideways. Hasn't done anything.
Yeah, well, I still like Paychecks. I mean, when I say I like it at about $90, $95. But again, that's just me being greedy. It hasn't really gone anywhere.
So HireQuest is another one that I'm sort of really keen on as well. But that's still pretty good. But I still haven't purchased it. So but nothing's really gone down a whole heap that you think, wow, that Louisiana Pacific Corp, that's a Buffett type buy there, but that's linked to housing, and as you can see, everything, like it's impossible for me to buy that. And a couple of the Australian ones here, like Codan, that's the metal detector type.
Yep.
Look at that. Some 43. So just huge gains here on some of these stocks.
Adobe as well. Oh my God. It's just flown. Yeah.
So we are picking it. So we are, we're not, there's easy to pick quality, but picking it at a price, that's what the hard bit that makes me, every week I can pick quality. Yeah, I can go, MasterCard, Visa, have a go at this,
There you go. It's the discipline of actually buying it.
So I probably should be buying some of these, a little bit more, like nibbling on them at least. Starting a position when I actually, can see that they got quality. But lesson learned. But yeah, I'm just wondering, is there any fallacies in that number, that 50, nearly 16% compared to 5.5?
Well, I assume they're equally weighted, yeah?
Yeah.
You've assumed equal weight with all the, well, not
like, am I
not really.
taking
I
on
mean,
more risk here, or I'm, I don't think I am taking on more risk here to get, what's happened
no.
here. So
You haven't included their betas, which again is you can have an argument about whether just having a look at their beta is actually
risk,
risk in a sense, because it's volatility of the share price, which but yeah, I mean, you've got there's a lot of quality stuff. There's a lot of things that people would categorize as better than the average stock. I mean, I think that's most of them, isn't it?
Yes.
I mean, Adobe, VeriSign, FICO, Equifax, Microsoft, FactSet, Visa, Doc Martens, Otis. I mean, these are all Novo, Nordisk. Yeah.
It's not like I'm bottom bashing here,
No.
picking up, deep value or anything here. These have got balance sheets.
Yep.
Nearly every single one of them's got, no debt. So, yeah. So I sort of changing my thinking here a little bit. Maybe I should be indexing into these a little bit, as I like them, as I understand them, and I think, I'd hold that for 5 years. I don't care. So
yeah, maybe you should be. Yeah. Yeah. I guess one thing is you look at that. I mean, maybe you should be thinking the opposite. That if you actually did hold them, you'd be thinking about trimming. Because if you bought Adobe and you think, well, I'm going to make 10% a year out of that for the next 5 years, so you're already there.
Yeah. Well, I would be. I'd be trying to get at my initial investment. That's what I'm doing with Netflix now, because it's gone up so much. I said, I should be trimming off that a little bit and keeping a few US dollars. And because if there is a correction here, Netflix is going to get, discretionary. It should be hit a little bit fairly hard, I would think. That's the sort of thinking I've got. But yeah, you just look at the chart and you think, I could run up double from here. But yeah, you got to trim somewhere along the line. So.
Yep. No, it's very good, and it's good to do this for our own accountability reasons. We should say that most of these picks are yours too, so you brought them to the table. So what you have bought some sweetness this week. We move on.
Yeah. So it's
old Hershey.
Yep, something that everybody can understand. Like, there isn't anybody I could speak to on the street who doesn't understand this company. And we should be getting back to that stuff, not this super complex derivative type, investing that we get involved, black box type.
The old Peter Lynch stuff. Going back to Peter Lynch. Buy what you know.
Yeah. Are people going to be eating a chocolate bar in 5 to 10 years? It's probably a good chance. And even if there's a salt tax or a sugar tax, they'll just adapt. And
they'll just make everything smaller and charge you the same price for less grams in the bar, and which they've been doing for years anyway. So
so you can have a look at some of these numbers. The shares outstanding. That's all going in the right direction. Price to cash flow here, it's in the 20s, but that's not a bad price to be buying it. It does get a little bit lower than this. You could get 20-30% lower than this. Look at these return on invested capitals. They're just solid here in the 20s.
Yeah.
And that's what you should be looking for. They don't go out buying crazy crap. Not out here buying a software company to attach onto their frickin' Hershey bars or something. Not doing anything.
They're just keeping it in-house, sticking to what they know.
Yep. You can see here the payout ratio is a bit high, at 48%, but you're getting a dividend on top of that, and interest coverage here is good. yeah, just a solid company that you can, got a little bit of debt here. So you got, getting up to $5 billion worth of debt, but
Oh wow. Yeah.
so that is, but you look at the free cash flow, you're getting 1.8 a year coming in.
Yeah.
So
Why did they just seem to have, I mean, they've doubled their debt in the last sort of 5 years. I wonder what that was about.
they're buying,
Acquisitions?
yeah, they're buying stuff. So they're buying
Yeah.
little brands here and there, just to bolt on. And in this business, it sort of makes sense. If you've got the distribution channels and you bolt
Yep.
on a little extra, chip maker or something like that onto
Yep.
you're not going to be paying anything more in your capex to run all the distribution channel, and it's just going to be you'd be able to, that word synergies, it's going to
Yeah.
come. You got to be careful with that word a little bit, but it sort of helps out there in the long term. But yeah, you get these huge hits to your debt book here a little bit, but I think they can handle it. You can, yeah, look at those, just cash flow coming in. You think, oh, the
Yeah.
last couple of years, oh yeah, they would have got a bit of
Almost 2
boost.
billion a year in cash flow coming in.
Yeah, and you look at it,
Uh,
2017, it was half that,
yep.
and like
Yep.
so 19, and they've just kept it up in 2022. I would expect it a drop. I would expect normally when I look at these things, 2022 equals 2019,
Right.
and you can see here that they've definitely, kept it on.
Grew straight through. Yeah. Yeah. I mean, there's a dip in 2020, but other than that, that's the only blip. They just keep 2021's back to normal, and then
Yeah.
up and away. Yep.
Yep. And that's what you want to see with someone who's got quality brands that can hold, because they would have jacked up their pricing.
Yeah.
You've talked about this before multiple times,
Mm.
it all looks good, but the volumes aren't keeping up there. But, they've obviously been able to put that pricing in and still
Yeah.
kept volumes sort of half decent. So
Well,
shows
it's
you got a
just, I
strong
mean,
brand.
you've got a strong brand, obviously. I mean, Coke just keeps putting through price rises. It doesn't matter. People, and yes, there's been, I think we're going on more than 5 years now of year over year decreases in the volume of carbonated drinks. But Coke's like everybody else, they're not just selling Coke, they're selling energy drinks and
Yeah.
all kinds of stuff. So they're able to raise prices. So they just do it.
Mm-hmm. Well,
So yeah,
that's how you're in a quality business.
yeah,
You're
yeah.
not in a quality business when you can't lift your prices and everyone kicks and screams, and I'm going to switch and go somewhere else. Well, Hershey's,
How does
yeah.
this how does this compare to Buffett's favorite See's candy? Do you know,
Well,
in
it's,
terms of metrics?
I'm seeing, similarities here, it's
Yep.
obviously not as good as See's Candy. See's Candy was a premium type business.
Yep.
And you see here, like you can see that in the gross margins, like they're
Yep.
only 43%. So it's more of a, large scale,
More
type
volume.
business. Yeah. But there you've still got room to grow as well. Like Hershey's still isn't in Australia. But, there's other little
They are
markets.
actually.
Are they?
They are. So, well, you see on your little graphic there, Reese's.
Yep.
Yeah. So they're sold here, and only recently, I think, in the last 18 months or so, that I've seen show up at the wholesalers is Hershey's cookies and cream bars. You still can't buy those in the supermarket, but you can buy them wholesale. And the thing is, they fly off the shelf. They empty the
Really?
shelves out. Yeah. Yeah.
Yeah, I have seen them, but it's all new. It's all starting, and
Yeah.
so that market has got a heap to grow. Like because Cadbury just dominate it. There's no real, other players in the market there, but these guys know what they're doing. They invented it.
Yeah.
Like this is
Yeah.
where chocolate,
Well,
cheap chocolate came from. So
in Australia, it's three majors. I mean, it's Cadbury's, Nestle, and Mars. Mars bar, Snickers, Twix, Bounty. There's another
Okay.
one I'm missing. That's about it. But Cadbury's huge. You go across the range there, and then Nestle, and and that's really it. And Hershey's is barely in there, are they?
Yep,
But,
that's right. Room to grow.
So yep, definitely room to grow.
Yeah.
Yeah.
So that's my sort of take on it a little bit. And I think, everyone knows these brands, but, they don't,
Yep.
even Reese's, they sort of know them, but they don't, nobody really consumes them in Australia. It hasn't been brought into the culture that much. But I think over the next 10 years, we might see more of it.
Yeah.
Yeah.
Yep. All right. Another one we can add to the list. There you have it, ladies and gentlemen. This week it's Hershey's. Go get yourself a Hershey bar if you can find one. They're pretty good.
Yep.
So how about we'll leave it there, Tim?
Yep. Sounds good.
Good on you. All right. Thank you, everyone. We'll see you next time.